Good day folks, it's Jim here from FX Charts. It's Thursday the 21st of March. Well, the US dollar and yields are both sharply lower after the Fed exceeded dovish expectations and effectively put rates on hold for the rest of the year, whilst also lowering its future economic growth forecasts. This seems to have dented any upside momentum for the dollar in the days ahead. Although the EU and China and other economies, of course, have just as bad or worse growth outlooks of their own. And looking ahead to today, we've got the Australian unemployment report for February coming up shortly, and then both the Swiss National Bank and Bank of England interest rate decisions later in the day, along with the press conferences and statements. So we will get a little insight from this data, but it looks as though the volatility is going to stay with us in the days ahead. We'll start by going to have a look at the charts. I've got a 10-year bonds chart here, and US yields, 10-year yields, are at their lowest of 2019 so far, and coming in just now to meet this FIBO support here. That should be strong at around 2.5%, just above 2.5%. But if we do go through there, then I think we're probably heading sharply lower again. There'll be some work to do in here, but it looks as though we could head back towards the 200-week moving average. This is a weekly chart, yeah, and that's at just at 2.35%. The indicators, or both the weeklies and the dailies, are looking pretty heavy as well. So it does look as though yields are going to head lower, and that's going to keep the pressure on the dollar. Now, this is a weekly dollar index chart. We've come back down here and we're sitting right on the 200-week moving average at the moment, and although the weeklies are not doing an awful lot, they're looking slightly heavy, so I suspect the dollar could remain under pressure now. If we go back and look at the daily chart here, as you can see, we're also sitting on the 200-day moving average, and the daily indicators are looking pretty heavy. We've broken some of this trend support here, and it does look it looks pretty heavy. So we're just under 96 at the moment, having fallen from around 96.5 earlier in the day, and there's support at this level, 95.85, below which we're heading back down to 95.20, which suggests the euro should make some gains out of this. But of course the euro's got problems of its own. Let's go and have a look at that chart. And here is a 4-hour euro chart. Now we're sitting at 114.25 at the moment, in the process of breaking above the FIBO resistance here. We end up to 114.5 immediately after the result was announced. But the indicators do point higher, although the stochastics are showing some degree of divergence. It's only a 4-hour chart though, but looking at the dailies, the indicators are a bit more neutral really, but it does seem as though we are in line for a test of the resistance up here, which is at 114.80. That's the 200-day moving average, and then above there we're looking at 115 or so, yeah, 115. And it does seem as though we could get there. So buying dips would seem to be the way of it at the moment. Although, having said that, if we were to approach 115, I don't think we're going to go up in a straight line, and that might not be a bad sell either. So probably range trade it for today, 114, 115. Elsewhere, what have we got? Dollar yen has broken. Dollar yen's broken lower. It's sitting just below this level here, which is the 100-week moving average. It had been confined by the 100 and 200-week moving averages for the last month or so, but it does appear to be breaking down. Having said that, the weeklies are pretty neutral, but the dailies are pointing a bit lower. So dollar yen is really the purest of the currencies in that it follows the bond yield market pretty closely. And if you do think yields are headed lower, then probably dollar yen is a decent sell. I think probably looking to, if we saw a rally to 111 today, I'd probably look to sell that, hoping it to bite back nearer to 110. I won't go through all the currencies, but the Aussie is interesting. We've got It's currently at 71 and a quarter, having been up to 71 and a half overnight. Now we've got the unemployment data coming out later on this morning in about an hour and a half's time. The expectations are for a rise of 15,000 with the rate staying unchanged at 5%. Some of the reports I see are suggesting that unemployment change will actually be nearer zero, possibly even negative, and that might take some steam out of the Aussie. I kind of still like selling it towards 71 and a half because the RBA do appear to be headed for a rate cut or two later this year. But in the meantime, the 4-hourly charts are pointing a bit higher, and the dailies are looking positive as well. So if you do sell at 71 and a half, leave a tight stop, I think, above sort of 71.80. Alternatively, with the dailies pointing higher, if you were able to buy it below 71 today, that's probably not a bad bet either, with a stop loss probably below around 70.70. Elsewhere, we're looking forward to some of the other products. So this is a daily chart of the S&P 500. We did make a new trend high a couple of days ago, as you know. We've now come back to sit on this support here. It doesn't look as though the stock market's really liked the lower growth outlook. So we are a little bit lower today. And just looking at the dailies here, it does seem we've got some bearish divergence coming into play. So if we do break back down here, then I think we possibly head back down towards this level here, the 200-day moving average is just about where's that, 27.50. So it's some way off at this point in time, but that may be the direction of it. The other thing we'll have a quick look at is oil, which is doing all the right things at the moment. Let's go to a daily chart. Oil did it's breaking up through this resistance now. It's back above, well, it's at $60 a barrel. As I've said before, I still kind of like it. I think we can head up to the 200 day moving average, which is about 61 3/4. So once again, probably ideally keep a stop loss below the neckline here at around 50 or just below 58, but that might be too far away for some people now. So probably bring it up to say just under $59 or under, for those who really haven't got much leeway, leave it under the 50% level. But I think you need to give it a bit more leeway than that, and probably just under 59. So that's about it today. It's going to be a pretty volatile session again. The Bank of England and the Swiss Bank are both not expected to make any changes in policy, but their outlook is going to be quite dovish, and in the case of the Bank of England, I think very cautious given what's the never-ending story of Brexit. So we'll have to wait and see on that one. But anyway, have a very good day's trading, and we'll talk to you later. Cheers.